Welcome. Today we're diving into the essential tax considerations every investor should know when investing in private funds. Whether you're new to private funds or looking to optimize your tax strategy, understanding the tax landscape is crucial. Private funds such as hedge funds, private equity, and venture capital offer unique opportunities but also come with specific tax implications. In this video, we'll break down the key tax issues from fund structure to reporting requirements so you can make informed investment decisions and avoid costly surprises. Let's start by understanding what private funds are and why tax planning matters. Private funds are pooled investment vehicles that are not offered to the general public. They include hedge funds, private equity funds, and venture capital funds. These funds typically have fewer regulatory requirements than public funds, but their tax treatment can be more complex. Investors in private funds are often high net worth individuals or institutional investors. Understanding the structure of these funds is the first step in grasping their tax implication. The fund's legal structure, such as partnership or corporation, will directly impact how income, gains, and losses are taxed for investors. Structure of a private fund is a key factor in determining its tax treatment. Most private funds are structured as limited partnerships or limited liability companies (LLCs). In these cases, the fund itself is usually not taxed. Instead, income, gains, and losses are passed through to investors, who report them on their own tax returns. However, some funds may be structured as corporations, which can lead to double taxation, once at the corporate level and again when distributions are made to investors. Knowing your fund's structure helps you anticipate your tax obligations. A pass-through entity, such as a partnership or LLC, the fund itself does not pay income tax. Instead, all income, deductions, and credits flow through to the investors. Each investor receives a Schedule K-1, which details their share of the fund's income, gains, losses, and deductions. This means investors are taxed on their share of the fund's income, even if they do not receive any cash distribution. Understanding how pass-through taxation works is essential for planning your cash flow and tax payments. A private fund is structured as a corporation. It pays taxes on its income at the corporate level. When the corporation distributes profits to investors as dividends, those dividends are taxed again at the individual level. This is known as double taxation. While less common for private funds, it's important to be aware of this structure, as it can significantly reduce your after-tax returns. Always check the fund's legal structure before investing to understand the potential tax impact. Schedule K-1 is a critical tax document for private fund investors. It reports each investor's share of the fund's income, deductions, and credits. K-1s can be complex and often arrive late in the tax season, making tax filing more challenging. Investors must carefully review their K-1s to ensure all information is accurate and properly reported on their tax returns. Mistakes or omissions can lead to IRS inquiries or penalties, so attention to detail is essential. One challenge for private fund investors is the timing of tax documents. Schedule K-1s are often distributed later than standard tax forms, sometimes even after the April tax filing deadline. This can complicate your personal tax filing and may require you to file for an extension. Planning ahead and communicating with your tax advisor can help you manage these timing issues and avoid unnecessary stress during tax season. It's important to understand that taxable income from a private fund may not match the cash distributions you receive. You could owe taxes on income that is allocated to you, even if you haven't received any cash. This is common in private equity or venture capital funds where profits are often reinvested. Planning for potential tax liabilities, even in years with little or no cash flow, is a key part of successful investing in private funds. Private funds generate capital gains and losses from the sale of investments. These gains and losses are passed through to investors and reported on their tax returns. Long-term capital gains from assets held over a year are typically taxed at lower rates than short-term gains. Understanding how your fund realizes gains and losses can help you anticipate your tax bill and plan your investment strategy accordingly. Not all income from private funds is treated as capital gains. Some income, such as interest or certain types of dividends, is classified as ordinary income and taxed at higher rates. It's important to know the breakdown of your fund's income sources, as it affects your overall tax liability. Reviewing your Schedule K-1 and consulting with a tax professional can help you understand how much of your income is ordinary versus capital gain. Investors in private funds must also consider state and local tax implications. Some states tax income from private funds differently, and you may owe taxes in multiple states if the fund operates in several jurisdictions. Understanding your state's tax rules and how they interact with federal tax law is crucial. Working with a knowledgeable tax advisor can help you navigate these complexities and avoid unexpected state tax bills. Certain types of income generated by private funds, such as income from debt-financed property, can be classified as unrelated business taxable income (UBTI). UBTI is particularly relevant for tax-exempt investors, like IRAs or pension funds, because it can trigger tax liability even for otherwise tax-exempt entities. If you're investing through a retirement account, it's important to ask your fund manager about potential UBTI exposure. Investing in private funds through retirement accounts such as IRAs can be attractive, but it comes with unique tax considerations. If the fund generates UBTI, your retirement account may owe taxes, reducing the benefits of tax deferral. It's essential to understand the types of income your fund generates and how they might affect your retirement savings. Always consult with your tax advisor before investing retirement assets in private funds. Foreign investors in U.S. private funds face additional tax considerations. The U.S. imposes withholding taxes on certain types of income paid to foreign investors. These rules are complex and can affect the net returns for non-US investors. It's important for foreign investors to understand their withholding obligations and to work with fund managers and tax professionals who are experienced in cross-border tax issues. Foreign Account Tax Compliance Act, FATCA, and Common Reporting Standard (CRS) require private funds to report information about foreign investors to tax authorities. These regulations are designed to prevent tax evasion but can add compliance burdens for both funds and investors. If you're a foreign investor, make sure you understand the reporting requirements and provide any necessary documentation to your fund manager. Private funds have specific tax reporting requirements. They must provide investors with detailed tax documents, such as Schedule K-1, and may also need to file information returns with the IRS. Accurate and timely reporting is essential for both the fund and its investors. Delays or errors can lead to penalties or increased scrutiny from tax authorities. Staying organized and proactive with your tax documents can help you avoid problems down the line. Investors may be able to deduct certain expenses related to their private fund investments, such as management fees or interest on investment loans. However, the rules for deducting these expenses can be complex and may vary depending on your personal tax situation. It's important to keep detailed records and consult with a tax professional to maximize your allowable deductions and minimize your tax liability. Carried interest is a share of a fund's profits paid to fund managers. For investors, it's important to understand how carried interest is taxed, as it can affect the overall returns of the fund. Recent tax reforms have changed the holding period required for carried interest to qualify for long-term capital gains treatment. Knowing how your fund handles carried interest can help you anticipate your tax obligations and plan your investment strategy. Many private funds use leverage or borrowed money to enhance returns. However, leverage can also create additional tax complexities, such as UBTI for tax-exempt investors or interest expense limitations. Understanding how your fund uses leverage and the potential tax consequences is essential for making informed investment decisions. Always ask your fund manager about the fund's use of leverage and discuss the tax implications with your advisor. Distributions from private funds can take many forms, including cash, securities, or other property. Each type of distribution may have different tax consequences. For example, cash distributions may be taxed as ordinary income or capital gains, while in-kind distributions may require you to recognize gain or loss. Understanding the nature of your distributions helps you plan for taxes and avoid surprises at tax time. Tax loss harvesting is a strategy where investors sell investments at a loss to offset gains elsewhere in their portfolio. Some private funds may engage in tax loss harvesting on behalf of their investors. This can help reduce your overall tax bill, but it's important to understand how your fund implements this strategy and how losses are allocated to you. Discuss tax loss harvesting with your fund manager and tax advisor to make the most of this opportunity. Alternative minimum tax, AMT, is a parallel tax system that can affect high-income investors, including those in private funds. Certain deductions and income types may trigger AMT liability. If you're subject to AMT, your tax bill could be higher than expected. It's important to review your tax situation each year and consider how your private fund investments may impact your AMT exposure. Fund of funds is a private fund that invests in other funds. This structure can add another layer of tax complexity, as income and gains flow through multiple entities before reaching the investor. You may receive multiple K-1s and need to track income from various sources. Understanding the tax implications of funds investments is important for accurate reporting and tax planning. You exit a private fund, either by selling your interest or receiving a final distribution. You may realize capital gains or losses. The timing and structure of your exit can affect your tax liability. For example, selling your interest may trigger immediate tax, while a final distribution may have different tax consequences. Planning your exit strategy with tax in mind can help you maximize after-tax return. Private fund investments can play a significant role in estate planning. The value of your fund interests may be included in your estate for tax purposes, and transferring these interests to heirs can have tax implications. Strategies such as gifting or using trusts can help minimize estate taxes and ensure a smooth transfer of assets. Work with your estate planner to integrate your private fund investments into your overall estate plan. If you plan to gift your private fund interests to family or friends, be aware of potential gift tax implications. The IRS imposes limits on the amount you can gift tax-free each year, and gifts above this threshold may be subject to gift tax. Proper planning and documentation are essential to avoid unexpected tax liabilities and to take advantage of available exemptions. Donating private fund interests to charity can be a tax-efficient way to support causes you care about. Depending on the structure of your gift, you may be able to claim a charitable deduction and avoid capital gains tax on appreciated interests. However, charitable gifts of private fund interests can be complex and may require special documentation. Consult with your tax advisor and the charity to ensure compliance with IRS rules. If your private fund merges with another fund or undergoes a restructuring, there may be tax consequences for investors. Depending on the transaction, you may recognize gain or loss, or your tax basis may change. It's important to understand the tax treatment of any fund merger or restructuring and to review any communications from your fund manager regarding these events. Secondary sales occur when you sell your interest in a private fund to another investor. These transactions can trigger capital gains or losses and may have unique reporting requirements. It's important to document the sale properly and to understand how the transaction will be reported on your tax return. Consulting with a tax advisor before completing a secondary sale can help you avoid surprises. When a private fund is liquidated, investors typically receive a final distribution of cash or assets. This event can trigger capital gains or losses, depending on your tax basis in the fund. The liquidation process may also involve complex reporting requirements. Understanding the tax implications of fund liquidation can help you prepare for your final tax bill and ensure all reporting is handled correctly. Private funds offer investors the option to reinvest distributions rather than receive cash. While reinvestment can help grow your investment, it may still trigger taxable income even if you don't receive cash. Understanding how reinvestments are taxed and reported is important for accurate tax planning. Always review your fund's reinvestment policy and consult with your tax advisor. Management fees are a common expense for private fund investors. Depending on your tax situation, you may be able to deduct these fees, but recent tax law changes have limited the deductibility of investment expenses for individuals. It's important to understand how management fees are treated for tax purposes and to keep detailed records of all fees paid. Performance fees, also known as incentive fees, are paid to fund managers based on the fund's returns. These fees can affect the overall tax efficiency of your investment. It's important to understand how performance fees are calculated and reported, and whether they are deductible or capitalized for tax purposes. Discuss performance fee implications with your tax advisor. Private funds incur various expenses such as legal, accounting, and administrative costs. Some of these expenses may be passed through to investors and could be deductible, depending on your tax situation. Understanding which expenses are deductible and how they are reported on your tax documents is important for accurate tax planning. If your private fund invests internationally, you may face additional tax considerations, such as foreign tax credits or withholding taxes. These issues can affect your after-tax returns and may require additional reporting on your tax return. Understanding the international tax implications of your fund's investments is essential for global investors. Investing in private funds with international exposure can lead to currency gains or losses. These gains or losses may be taxable and can add complexity to your tax reporting. It's important to track currency transactions and understand how they are reported on your tax return. Consult with your tax advisor if your fund has significant foreign currency exposure. Some private funds use derivatives such as options or futures to manage risk or enhance returns. The tax treatment of derivatives can be complex and may differ from traditional investments. Understanding how your fund uses derivatives and how gains or losses are reported is important for accurate tax planning. Private funds may invest in debt instruments such as loans or bonds. Interest income from these investments is typically taxed as ordinary income, which may be subject to higher tax rates. Understanding the mix of debt and equity investments in your fund can help you anticipate your tax liability and plan accordingly. Private funds invest in real estate, which can have unique tax implications. Real estate investments may generate depreciation deductions, rental income, and capital gains. Understanding how your fund's real estate investments are taxed can help you maximize tax benefits and avoid pitfalls. Review your K-1 and consult with your tax advisor if your fund holds real estate assets. Private funds may invest in energy projects such as oil, gas, or renewable energy. These investments can offer special tax incentives such as depletion deductions or tax credits. However, they can also add complexity to your tax reporting. Understanding the tax benefits and risks of energy investments is important for making informed decisions. Venture capital funds invest in early-stage companies and can generate significant capital gains if investments are successful. However, these funds may also generate losses or have long holding periods before realizing gains. Understanding the tax treatment of venture capital investments, including qualified small business stock exclusions, can help you optimize your after-tax returns. Hedge funds use a variety of investment strategies, which can result in a mix of ordinary income, capital gains, and other types of income. The tax treatment of hedge fund investments can be complex, and it's important to understand how your fund's strategy affects your tax reporting. Review your K-1 and consult with your tax advisor to ensure accurate reporting. Effective tax planning is essential for private fund investors. Strategies such as tax loss harvesting, timing of distributions, and charitable giving can help minimize your tax liability and maximize after-tax returns. Working closely with your tax advisor and staying informed about tax law changes will help you make the most of your private fund investments. Given the complexity of private fund taxation, working with an experienced tax advisor is highly recommended. A good advisor can help you understand your tax documents, identify planning opportunities, and ensure compliance with all reporting requirements. Building a strong relationship with your advisor can save you time, money, and stress in the long run. Wrap up: investing in private funds offers many opportunities, but also comes with significant tax considerations. Understanding fund structure, income types, reporting requirements, and planning strategies is essential for maximizing your after-tax returns. Stay proactive, keep detailed records, and work closely with your tax advisor to navigate the complex world of private fund taxation. With the right knowledge and support, you can make informed decisions and achieve your investment goals.